Hello, guys, and welcome back to Leah's Lifestyle. We're here again on another Invested the Rule Number 1 podcast, and we are on number 8 today, buying $10 for $5. This is a part 1 section, so let's just jump right into her. Boom! Little happy dance.
Hi, I'm Phill Down.
Hi, and I'm Leah
We're here to
Deering.
talk about money. Rule 1, and Rule 1 being that thing that Warren Buffett said about investing, that there's 2 rules of investing. Rule number 1,
Two
don't lose
rules.
money. Rule number 2, don't forget rule number 1.
Do
So
not
we're
forget
really
the
out to
rules.
figure out, how do you go about following Rule 1, following the advice of the greatest investors in the world, and apply that? Is that possible for just a regular guy?
It is.
Regular
It
gal?
is possible. I think so.
How on earth is a
I'm
regular person
doing
supposed to
it.
do this mysterious stuff?
Yeah, particularly when those guys...
I'm starting
If you're
to.
not going to learn how to invest,
Mm-hmm.
you should just put your money in an index fund.
Yeah,
know,
but you
They're
can.
basically pushing you away from the notion that you could do this. So it's a really interesting question about whether...
Again, index funds are not bad. You could probably find like a robot-controlled, especially an AI robot-controlled one. You probably could make one now, honestly, pretty easily. Just go to ChatGPT and ask it to do so. Make sure you got your prompt real good, and maybe you need to find a coder to make sure that it's set up perfectly. But nonetheless, you could probably do it where you get like good 15, 25%, 25% back. But that's a maybe, I guess. Maybe it could do that. It's maybe. I don't see why you couldn't, but you'll have no idea what you're doing or what you're putting your money to. You won't know, like, what companies you're adding into. You could be, like, supporting companies who want to live life like Hitler did, you know what I mean? So I think it's really important for you to know what companies you're checking out, know where you want to put your money, know that where you're putting your money is where you want it to go in the world that you want to see in the future, because it might just not be the same,
a
Circle of
regular person can
competence.
actually invest like a Warren Buffett or Charlie Munger.
And to me, it is a question.
Yeah,
I'm not convinced.
it's a legit question.
Not convinced. She's still not
the problem-
convinced. Her dad's
and
making
actually,
a bunch
if
of
you
money and
just
she's
put
still
money
not
in a mutual fund
convinced.
and do
Okay.
With it long term,
Okay, sure.
that would be great. I mean, just put your money in there, ride through the bumps. That's really Buffett's advice. Go through the ups and downs in the market. In the long run, you'll come out okay.
Yeah.
The problem is there's probably in the ballpark of 50 million baby boomers who don't have any money to retire with or don't have enough, and they're looking at the rate of return in the stock market and just going, this is not going to get me where I need to go.
Yeah.
Plus, you got an awful lot of people who are your age who are like, hey, man, I don't want to work till I'm 65.
Right.
75.
Well,
whatever
Who
the
would?
New era is.
Who would?
It's not just that, though. I mean, everybody I know has student loans. We're all paying student loans. And that's where the money's going.
And student loans have a high percentage rate. I was so lucky.
You get paid
And I'm
really
paid
good.
That's so, it was crazy. As I went through one year of school, I pretty much had everything paid for. I probably could have gone to another year for free, but my mom encouraged me not to for some reason. Why would your parents do that unless they want your failure? Anyways, enough about me. And I was super lucky that I only had to take out a small loan from the government at it would not change I made sure, I don't know how I was successful at doing this. I don't remember being this smart then, but apparently I was. But I made sure that the one that I got, that the interest rate was stuck at a 4%. They couldn't change it. I remember specifically looking for one. I don't know where I got that information, but I specifically made sure to get that, the loan that I paid had a stick of a 4%. And I made sure that it wasn't already baked into the loan, so I could pay the loan off sooner, leaving me with a lower interest rate. And I was successful at doing so. So, boop, boop. Less than 5 years.
Oh, that's right.
Yeah. Because
Not many people are that lucky, though. So,
Yeah, so, I
Yeah,
mean,
so everybody
yeah,
has
lawyers and
different
doctors have
loans and
way
investing
more
for down
loans,
payment.
way higher
You know,
percentage
maybe
rate.
it's a separate issue, but it's really difficult to think about investing at this point in life. And so I think there's going to be a point where people need to be getting a higher return than the market rate.
Yeah. And the market rate's like, what,
and
3?
shoot, it
10%?
can be done. And by the way, there are a number of people who are doing it, so I know it can be done. But if it can be done just by the average person, if the average person could put a little time into this and learn how to do this, then if you started doing this when you're 22,
Just a little bit of
25,
time.
something like that.
And here's the thing, even if you're starting at 30, right? And technically I started like 3 years ago, like reading books and stuff, but like I was too emotionally scared to put anything into the stock, do anything with my money. And I was more worried about like being able to see my family and like going up and down from the city that I had just moved to go be with them and stuff. So I spent all my money doing that instead of putting it in the stocks, which I would be sitting way better now if I had done that. Anyways, it's one of those things where like all that education has built me up to this point where now I feel confident to not only share with you guys, but I'm actually doing research. Like I wasn't even doing research on companies like I should have been a few years ago when I first started learning this. So it's a big, really big thing that you just start. even if it takes you a few years to really actually get into it, it's such a big thing that you just start. Even if you're just listening to podcasts, even if you're just reading books, even if you're just looking at the stock market, I think it's super, super important for you to just try.
You don't have to worry about staying in a career. You don't have to worry about struggling to, keep up with whatever's going on.
And that could be the outcome,
in your life.
right? So a little education goes a long way.
At some point, that might be true. I don't know if it's going to be true that early for most people, because you have to constantly save enough money to put that money into the market to then make returns.
Right. Well,
yes and no. I mean, you remember that how I did it, because I'm your dad, so you kind of probably watched this happen, is that I raised money from other people.
Right.
Once I got a track record and had experience, then, I don't know, I'll put it like this. Warren Buffett said, if you have a good track record, you could be on an island in the middle of shark-infested waters and people will swim to you and give you their money. And that's exactly how he started. And
Fair.
Every other fund manager that I know
Fair.
that invests like I do started up. They didn't start with family money. All these guys didn't come out of like super rich money. They just got a good track record and then started bringing in other people's money. So I really do think it's possible to even do this as a part-time thing and crank it up. So if you're, by the way, I mean, heck, do the math. Let's say you could save $12,000 a year pre-tax into some kind of either a Roth or an IRA, and you were making 25% a year on that, which is our target number, right?
Right.
It's a huge number.
Huge number, giant number, but it's absolute. I mean, to put this in context of what Warren Buffett did with small amounts of capital, not very long ago, he said that if he had $1 million to invest, that actually said if I only had $1 million to invest, I'd be making 50% a year, guaranteed.
Wow.
50% a year.
Wow. 50%.
Genius.
He is. Yeah.
I mean, why could he make 50% a year?
Yeah.
Because he knows how to buy
Yeah.
really good companies. When
But
they're
he
sales.
has
You
the
can buy
education. He
$10 bills
and the
for $5
practice.
and do it over and over again. You can make an awful lot of money fast.
Right.
And in fact, I mean, last year,
If you know the companies to put it into at the price in which to put it into, though.
Investing only $1 million.
Oh, sorry, got off the track there. Because large amounts of capital are harder to employ.
Yeah.
It's harder to allocate for high rates of return when you've got billions of dollars. So he's at
Billions.
$20 billion right now.
Right.
And,
To billions
so
is too much
it's tough for him
to.
to find investments that'll move the needle because they
Right.
have to be so much larger.
Right.
If you're starting with $1 million, you can move the needle with a $100,000 investment.
Right.
He has to put that money into larger companies
Exactly.
that can handle that
Right.
kind of investment.
Yeah, so
Right.
he's looking for multi-billion-dollar investments. And those
Much
are really hard to
larger.
find on sale.
Right.
So it's not like you're finding $10 bills on sale for $5. You're looking for
$1 million on sales for
$200 billion bill on sale for
$500,000. Yeah. Exactly.
That's
Exactly.
not going to
Yeah.
escape the notice of good investors, right?
Right.
And what we want to talk about today is how to determine if that $100 bill or $2 billion bill is on sale or not.
So essentially what he's
Yeah,
saying
so
is it's much easier if you have like a $10, $500 to find businesses, good businesses that go on sale that are within your circle of competence. Not like just the big 5, not the just big 10, but like other companies that have been around for plenty. And there's so many. The S&P 500 is literally just a conglomeration of some of the stock market. 500 of the best running stocks. Like it's not even all of the stocks. It's just whatever they think the first 500 best ones are. So there's so many. There's enough for all of us.
And the reason we want to talk about that is because, as you guys have heard so far, we've been running this 1-minute piece of phenomenal investing advice from Charlie Munger to the BBC a couple years ago. So let's do it again because it lays out the context.
Yeah.
So we
They
thought this would
keep
be a
listening to this
4-part
every
episode.
single
Or 4
time.
episodes.
We're
we may
in.
never leave this
We
subject.
may never leave this.
Every time you listen to us, you may have to listen to Charlie for 1 minute.
Yeah,
You'll
right.
have it memorized like we do.
Number
So let's do it
8.
again.
It's
Let's
the
do it
8
again.
podcasts, and they're doing the BBC run again. Yeah, the same one. We've listened to this every single time. Here we go.
Understanding. And then, once we're over that filter, we have to have a business with some intrinsic characteristics that give it a
Intrinsic.
competitive advantage. And then, of course, we would vastly prefer a management of the place with a lot of integrity and talent.
Compatible advantage. Good management.
No matter how wonderful it is, it's not worth an infinite price. So we have
Fair.
to have a price.
Fair margin of
Makes sense.
safety.
And
Makes sense
gives margin of
price.
safety considering the natural vicissitudes of life. That's a very
Natural
simple set of ideas.
vicissitudes.
And
I
the
love
reason
that word.
Our ideas have not spread faster is they're too simple. The professional classes can't justify their existence. So that's why they have to.
Professional classes.
It's also
The
obvious
ones
and
who
simple.
teach it.
What would they have to do with the rest of the semester?
The people you
And
give
last
your
time-
money
last time we
to.
were talking about the paradigm that exists in the market to this day. That price is
Paradigm.
value. That
Price
the
is value.
amount of movement of a
Price
stock
is not
price relative
value.
to the S&P 500 is called volatility, but it is a
Price is what
a
you're
proxy
willing to
for
sell it
risk.
at. Value
And
is
that
what
there's
it's
a
actually
common notion
worth.
that you cannot,
Two separate
since all
things.
prices and values are this, values equal prices and prices equal values. There's this notion that you can't get a good deal in the market.
Right.
Everything is priced properly.
Things are not
and
priced
therefore, if you want
appropriately.
a better than market rate of return, the only
Still
way to
not.
do that is to take a lot
We can
more
see
risk
that.
and try to time it properly so you're in it when the risk
In
is
fact, we know for a fact that's true because everyone knows that oil's being sold at like an alarming rate of like price. They're like over 100 for like what a gallon, about 100 gallons or something like that. And like then we have like this situation where like for a few seconds we think that like the war's gonna stop, and it drops 20% because people like start buying back into it, so it drops the price, right? Like it's just one of those things. It clearly is not based, the price is clearly not based on value. It's based on what people think it's going to be worth, how much people think there is, how much people are trying to buy it for right now because they think it's going to go out of stock. That's not how it should be done, right, in a perfect world. But we're not in a perfect world, and so the stock market can't be perfect, and so things are not priced according to value. They're priced according to emotional value, what we believe is going to happen and how it's going to function, what we're told is happening.
It goes up, and you're out of it when it goes down somehow. And this has become the paradigm of the entire stock market.
In fact, we know that for sure because oil companies have had their highest rate of like money coming in, right? What is that? Like how much they're getting back has been growing and growing and growing. They've been making sure that they are getting more and more money even when it's being strangled by, like, we have so much reserves. We're fucking fine. We could be selling oil right now to other countries and still be fine. So I don't know why I don't know.
99.9% of all funds
Lies.
running your mutual funds,
Propaganda.
Index is
You tell me.
short term. Like a long-term hold for one of the big mutual funds is like 3 months. I mean, actually, most of them don't hold much longer than a month.
Yeah, that's what it sounds like to me from what we were discussing in the last episode about
That's too short. A month to 3 months is too short. Compounding rates can't happen in that short term.
Some people still think that there is. So it sounds like you have to, like, basically these guys have to be investing short term in order to make any money.
Yes. If you believe in efficient market theory, then the only way you could possibly do better than everybody else is to guess properly that you're in a volatile stock, it goes up, and you get out and avoid it when it goes down. And amazingly, this is exactly how the market works. The Russell 2000 index, the RUT, is more volatile than the S&P 500. The Russell index is 2,000 small stocks. And so what you see
the Russell is
moving into the Russell when they think that the economy is going to be good and small cap stocks will go up fast. They'll move into there, try to get a higher rate of return than the overall market, and then move back to the S&P 500.
What are small cap stocks?
Oh, very good. Small cap stocks are stocks that are valued, like if you multiply the stock price times the number of shares they have, you get what's called a market cap or market capitalization. And the market capitalization of small cap stocks runs from something.
Okay, so small cap. I'm going to write that down because I didn't know what that was. Small cap. Small cap stocks. And it's, if you times it by 2, you get the cap price. Let's see, what did he say?
Like, I'm probably a little off here, but something around 200 million in the market, up to $1 billion, say. So rough, I might be off in the exact numbers, I forget exactly. But they sort of drawn the lines there between 100 or 200 million and about $1 billion in market capitalization. Those are small caps. And then it goes up from there for the S&P.
So 1 mil to 1 billion cap price.
500 in the Dow. But obviously, and the smaller these companies are, the more of them there is more movement in their stock prices because they're less actively traded, and because they're more go through more stuff as a small company in terms of their business.
So someone
they
buying
tend to be more volatile.
a chunk of stock of a small cap stock is going to make a difference in that stock price.
Yeah, it's going to drop it really
relative to
fast.
the total amount of stock that's actually being sold for that
Exactly.
company.
So these guys will buy in there and they'll drive those things up because they're big investors.
Oh, they buy in this price.
So the basic idea is you have to be a momentum.
And that's like penny stocks, essentially. I'm going to actually write that, like penny stocks. Add money. Drives it up. Then when you pull out, drives it down. More so than like the larger stocks. Typically when you buy in, it goes down first and then it goes up.
Investor, and your mutual fund is invested that way, based on, I think this part of the market's going to go up, so I'm going to move my money to that. And when I do, because I have so much money invested in a mutual fund, it moves it up.
Yeah.
Well, the big guys can move the market. So the market starts going up, 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 up. And when you think that part of the market, let's say the consumer products companies or retail clothiers or something like that, those are going up, so they step into them and start buying them, and they do go up because they're buying them. They go up, and more consumers are buying stuff, so the companies are giving good numbers every quarter, and those stocks are moving forward. And when these fund managers think that maybe this is going to shift the other direction, they exit that part of the market and try to move somewhere else where it's been low. And
right.
The momentum strategy to try to catch the rocket launches of each industry is how they try to beat the market. And not surprisingly, basically nobody ever does in the long run.
Right.
Except for people like Charlie Munger, Warren Buffett, David Einhorn, guys like that.
Right.
Crush the market in the long
Value investors.
They're not momentum
Rule 1
investors. Those
investors.
guys are what we call Rule 1 investors. They're focusing entirely on buying $10 bills and buying them for $5.
Mm-hmm. And then keeping them for 10 years or more.
The market. If anything, they probably go the opposite direction.
The natural vicissitudes of life.
Present opportunities. As opposed to problems.
Like
so the natural
with oil right now.
What are scary
if you have cash, like plenty of companies to be buying that are on sale.
All right, so big question.
Yeah.
How do we know if it's a $10 bill for $5?
All right, so we've sort of discussed that there's two different theories out there. The theory that it can't be, right? And then the theory that, at least in the short run, the market can misprice things because of emotions of fear and greed. So let's assume that we really believe that Charlie Munger and Warren Buffett are correct and that occasionally the market will misprice something.
Right.
How do we know what it's worth? That's what you're asking, right?
Right.
Okay, so again, we kind of go back to Charlie here and we ask, well, okay, what are the steps that Charlie went through there that tell us ultimately how we would get to the value of this business? And the first step was, are you capable of understanding the business?
Are you capable?
Yes. What they're doing when they're making t-shirts.
Mm-hmm. How they make t-shirts, when they're making t-shirts, what affects t-shirts, like the crops, right? Yeah, you gotta understand that.
You have to be capable of understanding the business first off. Second, you have to know, because you understand the business,
right?
You have to know that it has some kind of intrinsic characteristic that gives it a long-term, durable edge in the market or in the niche
good moat.
Mm-hmm. That's super key. All right. So first, do you understand it? And second, does it have this critical feature to it that gives it that has an intrinsic characteristic that we call a moat?
Right.
Like the water around the castle that protects it. Does it have that? Third, Charlie says we would like it to also have talented management that have integrity. But the first two things are really where you're going to put your attention. And once you sort of think you're capable of understanding that part of the market, let's say, casual fast food, or whatever, like Chipotle Grill kinds of restaurants. Let's say you figure like, okay, I can understand that stuff. That's where I eat every time. So let me just dig in and understand it. So assuming you feel capable of understanding that market, then your research becomes whether this company has a durable competitive advantage that has that niche and can hang on to it. It's the durability part that's really key. Because here's what you're going to do to figure out the value of the business. You're going to say that what's been going on historically here, this business has been around for 10 years or something, and I can look out and see what it's been doing. And because it has this niche, or this durable competitive advantage, this moat, I can see that it'll be able to continue that for a long time. And if I can see that, then I can put a value on it.
How are those two things related? If I can see that, how does that help you put a value on it?
Well,
do you look backwards at the historical numbers?
I'm going to look backwards at the historical numbers, and I'm going to say, okay, that's what it's been doing over a long period of time. And we want to look way back because we want to take out the valleys and the mountains, the ups and the downs of this business. We want to just kind of say, if we were to kind of smooth its last 10, 15, 20 years out through all of the vicissitudes of life, what would the overall growth rate of this business look like? What would the cash flow look like, and how is it growing? That's kind of what we'd be asking ourselves.
And then you would project that into the future.
And then we project it into the future. And so we're looking out the back window of the car at the road behind, knowing full well that looking out the front window, we're looking into the fog. But we're not driving real fast. And if we really see a straight road back there and we understand what the road should look like in the future, we can make a pretty good projection, ballparking, what this cash flow looks like out in the future. So I said two things a minute ago. I said the cash flow and how it's growing. The first and most important thing is that it has cash flow, that we have this owner's cash or free cash flow that comes into us, that if we own the entire business, we can put it in our pocket every year. Because ultimately that's what I need out of this business, is a return on my money. Okay, I'm gonna put my money to work, and I want my money to come back to me.
Right.
So please come back to me. So first thing I want back is my money. So I want return of my money, and then I want a return on the risk I took, on the money that I put into this investment.
So money back plus return.
Is some real steady cash flow into the future. Now what Charlie said is, you figure that cash flow into the future, and you can come to a conclusion about a price that makes sense.
Right. Okay.
But because there's ups and downs in life, we can't just go pay the price that makes sense.
Right.
We have to get a margin of safety on that price.
Just in case.
So we're going to discount that price so that even if the cash flow isn't what I thought it was, I bought the thing
on
at
sale,
half of what it was worth as a public company. And because I did, I can bounce through the vicissitudes of life over the next 10 years, and I'm going to be able to sell this for more than I paid for it.
So I'm actually going to make a note here, just like for myself. Like, you want to balance the value of the company with the natural vicissitudes of life by buying the value of the company half off. Okay.
Down the road sometime. I just listened to Warren Buffett talk about owning John Deere, And he said, he
not John Deere.
About companies he's still acquiring, and I think he's still acquiring John Deere stock right now as I'm speaking.
Mm-hmm.
And they said, why did you buy it? And he said, well, because
10 years ago.
Given the fact that the world is going to have 9 billion people instead of 7 billion people, and food is what they need, John Deere is going to be worth more in 10 years than it is today.
Which is interesting because most of our farming is for cattle, for animal
so that's what we're going to talk about
feed
right now,
than anything
how do
else.
Know what it's worth today. Cool. Okay. All right. So we're talking about sort of how to.
Wonder how John Deere is doing.
How do you do that?
Yeah.
All right. So Charlie's basically saying that we want this business that we understand with a big durable competitive advantage that's going to throw off a certain amount of cash flow. We're going to take that cash flow and we're going to figure out the value of the business based on recognizing that we're not going to pay as much for dollars we're not going to get for the next 5 or 10 years as we would pay for dollars today. So if a business was making $1 million a year with no growth at all, but it just could increase its prices by, let's say, inflation. So
their profit is $1 million.
Yeah, profit's $1 million a year. What would you pay to buy that $1 million?
You pay some multiple of the million.
Right. So let's figure it out. Let's say you wanted to buy a river touring company, since I'm an old ex-river guide in the Grand Canyon. These are almost monopoly companies. There's only like 12 of them down there, and they're protected by the federal government from competition. There's a little risk because you have to renew your license every 5 years, but no one's ever lost theirs.
Wow.
So, pretty risk-free business, but not a growth business. You can't grow it. You can only just keep up with inflation. So let's say that our perfect little business here is a river touring company that makes $1 million after tax every year. And let's say that I'm not this old, but let's say I was 78 years old, and you don't like the river touring business. You're my daughter, and you don't really like it. And so we want to sell this business to somebody so that I can just live off the last of my years on the beach, and you don't have to mess with this river touring company. You just want the cash to go on with your life. So how much would we sell it for? Let's figure this out, you and I together, because you'd like to get as much as possible, so would I. It's making $1 million a year. So let's have a conversation. How much should I sell it for, Danielle?
Well, it depends on the industry. I don't know the answer. It depends on the industry to know what multiple people generally use. So I've heard everything from multiples of like 5 to 12, depending on the industry.
Oh, that's pretty good. That's not that bad, actually. And the industry side of things is actually more about whether it's cycles, whether it goes through ups and downs a lot, or whether it doesn't. So some industries are really steady and they don't go through business cycles much, and people are willing to pay more for that than a business that goes ups and downs, ups and downs. This particular business is like on railroad tracks. It doesn't matter almost what the economic cycle is. People still go down the Grand Canyon on rafts, and they fill up those user days every year all the way to the max. So
it's so limited.
So it's so limited, yeah. So this is like $1 million a year no matter what. So you probably get a little higher multiple in that range. So let's say if we're making $1 million a year in constant dollars, then we could think in terms of the very upper part of that range. We could try to sell it for $12 million.
So what makes you just decide that and pick that?
Well,
you can justify it to a buyer.
Well, I think you named it a range, and I'm kind of going with it. Let's just go with that range, wherever you got that number. That was the most that range went, 5 to 12, and we're saying 12 million. So now let's put on our buyer hat. Well, first off, let's keep our seller hat on for a second. Why would we accept $12 million today in exchange for $1 million a year that's going to go on for the rest of your life? Why would we do that deal?
So we can stop running the company.
Yeah, so we don't have to worry about it anymore. But let's even say that the managers of the company run it really well. I really don't do that much.
Well, then I say keep it.
Fair enough. Because that's actually quite smart to say keep it, because you're going to get $1 million, $1 million, $1 million. But if you think about it, you're about to get $12 million worth of that business all up front.
Right, so you take your 12 and you invest it,
yeah,
and you make more money on your 12. That's what you're saying.
No, but it's a good thought.
No?
Let's take a look
You're
at
not
that.
making more money on your 12?
Yeah, you are. But let's say, okay, you take the 12, and the federal government takes 2.5 because of tax. Let's just round it off to 2. So you've got 10 now. And with
Okay, I'm so sorry. I stopped listening a little bit because I had to check out John Deere. And I just want to say, back in 2016, when supposedly they were buying up more stock, they were buying it up around a little under $180 some per stock, right? Right now, it's at $580. So that's $500. Like, he's made bank on that buy, truthfully. Made fucking bank on that. And if they had bought back in the 90s at all, it was like $8-10. So he's made a fucking shitload, which is so funny. The analyst rating right now is saying buy. This is not the time to be buying John Deere. This is the worst time to be. If you have John Deere, this is a great time to sell. If you've had John Deere before 2016, this is an amazing time to sell right now. You're going to make so much fucking money. Not time to buy. Why do they analyze? I hate seeing these analyst ratings where like everything's at the top peak of like where they've been at in the last 10, 20 years, and they're like, buy it now. No, don't buy. Do not buy. This is when people should be selling. This is when people should be making some money off of it. At least if you think they're going to go out, or if you want to, like, you need the money for something. But Floop, goodness dang. I could not imagine how much money he made off that. I wonder how much he put into it.
With that 10, you can invest it in a long-term T-bill at 3% a year and get $300,000 a year forever.
Yeah.
So that's kind of nice.
I mean, it's less than $1 million.
It's less than $1 million.
Kind of nice.
But
Less than $1 million.
And you don't have to do anything.
Yeah.
Didn't we stipulate that this business is pretty much guaranteed?
Yeah, this is pretty much guaranteed.
So that's the difference between pretty much guaranteed and guaranteed.
Right. Which is
So
the
and
difference
that
between
difference is apparently $700,000.
yeah, it's like on The Princess Bride, the difference between being all the way dead and just mostly dead. Pretty substantially important. So there's always risk with a business. You can't avoid that, right? There's no certainty.
Right.
And there's the most certainty you can get with money is, we just say, a U.S. Treasury bond for 30 years, which is considered risk-free. So we get $300,000 a year, and so that's one reason we might.
And even
wanna
still,
what we're gonna
you
get paid
make
for this
more
thing
than
is not
that.
enough to make it worth doing the deal. But we don't want to forget, we've also got the principal. We've got the whole $10 million sitting there, and if we wanted to, we could amortize the distribution of that $10 million over a bunch of years, and you might find yourself getting $500,000 or $600,000 a year for the next 30 years before it's fully distributed. And then you might think, well, that's pretty good, actually. I'm going to get $500,000 or $600,000 a year for the next 30, 40 years. I have no risk whatsoever. That might be why you'd be willing to take 10 or 12 million for the business.
Okay.
All right.
Why are we talking about selling our private business?
Because we're trying to figure out the value of a thing.
Yeah.
Okay.
Right. Which is really important. What we're talking about is like figuring out the value of this business. So we can already see, we're kind of wondering if we're really getting enough money
Right.
at 12 million to be worth selling off this $1 million a year forever. Right?
Yeah.
Okay. Now, if you're a buyer, you're looking at this the absolute opposite way. You're looking
Right.
at it and saying, I have $12 million in my pocket.
I
and
got $12
want to
million
put that
in my
to work.
pocket.
Now, why would I not just go get the T-bill? Well, because I think by taking some risk above the risk-free rate, I could get more money per year.
Right.
All right, so I'm going to look at buying this company, and I'm going to think, how much would I be willing to pay for it? Considering that every 5 years they have to renew the license, considering there may be some huge terrorist attack and it just shuts down all tourism everywhere in the country, considering that, who knows, something might change. They may dam up the Grand Canyon. It's proposed every year to put in 5 more dams to feed power and out to Phoenix or something. So there's always the vicissitudes that Charlie's talking about that
Right.
you have to deal with. So I'd be willing to exchange my $12 million for some chunk of vicissitudes, and I got to decide if I want to do it for this company. But we can see right away we might be negotiating about a price here, but it's not an infinite price on one side and nothing on the other. There's a place in the middle here where we're going to get if you're a willing seller and I'm a willing buyer. And I'm guessing it's in the ballpark right where we're talking about right now. And the reason I'm guessing that is because most private businesses aren't that much better. They're not that perfect.
Well, and most private businesses that are purchased in order to grow them, and this one
Right.
really doesn't have any growth opportunities.
No growth
So
opportunities
it's
here at
rather
all.
unique.
Yeah, no growth
It can
opportunities.
be rather
Very
unique. It's rather unusual.
And so the value of this business is going to be in this ballpark. I mean, give or take $2 or $3 million. We're pretty close to the value. It won't be 20 million. Right? It won't be 20 million because I'm not ready to part with $20 million to get $1 million a year. Let me put it in really stark terms. I'm not going to get my money back for 12 years.
That's a long time.
Long time to wait to
Yeah.
get my risk off the table. Now, granted,
Right.
my risk is getting less every year, but come on, man, that money could be working someplace at least $300,000 a year, and I want to get rid of that risk. So 12 years to get my money back is a long time. 20 years, forget it.
No.
Want to hear how crazy things can get in the public markets? Just as an aside, if
Yes.
the PE ratio is the amount of time that it takes to get your money back, let's say if you have no growth of the business whatsoever, the price that you're paying divided by your earnings tells you the number of years that it'll take to get your money back. So let's say you spend $12 million on this company.
Okay.
We make $1 million a year. So the PE ratio, the price of the company is $12 million, the earnings are $1 million. The PE ratio is 1 divided into 12, or 12. So the PE ratio here is 12. So that means if there's no growth, it would take me 12 years to get my money back. Yahoo had a PE ratio in 1999 of 11,000.
Whoa!
So if there's no growth in Yahoo, it would take 11,000 years to get your money back.
Wow,
so that meant people putting
that's
their money in there thought there would
insane.
be enormous growth. So
But
then
there's
you
not.
apply what enormous growth would mean to Yahoo's revenues and earnings, and it turned out that within 20 years or something, ballpark, Yahoo would have to be the size of the entire economy of the United States.
Whew.
This is 1999.
Oh gosh.
To justify that price, Yahoo would have to grow so fast that it would take over the GDP.
I don't
of the
like
entire country.
Yahoo. I don't like their
So
email.
they
I
grow
don't like
too much
their
fast.
search engine. I don't like any of
I feel
it.
like that's all you need to say when it comes to efficient market hypothesis.
That is a
Damn.
pretty good data point, isn't it?
That's just insane.
That's insane, and people get crazy. It's like
Yeah, you
bubbled
gotta
and
know that.
past rationality.
Yeah.
Just pure momentum. I bought it, somebody will buy it for more.
Same thing
So
with the
back to our-
Tesla
our
right now. It's
literature
fucking
over here
bubbled.
To try to understand how we would get to a value, one of the critical things is we call the payback time. How long it would take me to get my money back. off the
NVIDIA
table
too.
with this private company. Well, the
What is
average.
that called in the investment world?
I don't know. There's probably some name for it, but hey, man, I wrote a whole book about it, so called Payback Time, as you know.
We're
So
gonna
it
read
wasn't
that
a real
book.
popular thing to discuss in the
I think
regular
that will be
world,
the
so I
next
don't know
book
if
we'll
anybody
read.
calls it anything, but I know that that's how we look at businesses as a private investor, in terms of how long is it going to take me to get my money back. So And I'm sure there's some yield to
Yeah,
purchase price
we need to
thing
know.
they've got in business school that matches that. And we're going to get a lot of letters telling us exactly what that is.
I'm sure there's a term for it.
Yeah.
I'm sure there is too. I'm sure they've got something at NYU that's exactly that thing. So that's one way you look at the value of a business is, am I willing to wait that long to get my money back? And that's what private equity does. Now, here's the cool thing. We know from being in the business for a long time that there's a standard in the industry of venture capital and private equity, what these guys will pay for a business.
Right.
And the average is what you just said, 5 to 12, which actually averages around 7.5. 7.5 to 8 is ballpark. A good company, private company, not a laundromat,
Right.
but something that's growing, and what they would be willing to pay for that risk to go in.
What are you
there
willing
go.
to pay?
About 8 years, if there's no growth. And I think as we discussed before, your Uncle Steve had
8
his
years is
company
not
go
long.
and it's sold in a range of, he didn't want me to give the exact number, but in a range of 6 to 10 on the earnings before taxes. So 6 to 10 for his company, and it was growing pretty good, and it went for 86 million. So you can
86 million. Whew.
what he was doing in terms of the earnings of the company.
That's a good
And
amount.
they're in the ballpark of what we were talking about. So this is a really important data point for public market investors, is to know
Right.
that private market investors are paying an average of 7.5 or 8 times earnings, and they'll pay a little
Which
more.
is why
if
we
it's
do
up
the
to 10 or
8
12
for
if there's
the
growth there, or if
payback
there's some
time.
monopoly. Right? They'll pay a little more, but they're not paying an infinite amount. That's what Charlie said. It's not an infinite amount.
Right.
There's a
It's
cap
not
price.
and there's some sort of sense to it.
Yeah, there's an actual range that is legitimately rational. It's like, okay,
And you
how
should be
long
able to
am I
find
willing
that.
to get my money back with the amount of risk that's involved in this business, and it's going to be a range.
Yeah.
It's not infinite, and so that means that businesses, unlike Picasso's, have a very rational way of arriving at their value, at least within a range of the value. And what Charlie is saying is, come up with that range of value and then buy it for half of that,
Yeah.
and that's your margin of safety.
You said earlier that on the public market, companies are generally valued at twice what they are on the private market.
Right.
So essentially, are we looking to buy a company at the price it would be in the private market on the public market?
Yes, we want to buy a public company at a private company price. Now, let me give you a couple of data points on public companies that are kind of help you figure out if I'm in the ballpark of reality here.
Okay.
The PE ratio for public companies for the last 140 years has averaged about 15.
Okay, let's go back. PE ratio.
Yeah.
Price to earnings ratio.
Price
Price to
ratio.
earning.
Can you just say again how you get that?
Yep. You take the price of the company
Yep.
divided by the earnings, and you get a number.
You get a number.
Right, which is the PE ratio.
PE
Price to
ratio.
earnings ratio. And what is
And that's
used
a commonly used number.
very commonly used.
Price divided
Now,
by earnings.
It's a
PE.
very quick and dirty way to kind of get an idea how expensive or cheap a company is. Because remember,
Right.
on the private markets, we were looking at somewhere between 5 and 12. So essentially, about double. It could be X or it could be 2X, depending on what that multiple is. So it's pretty significant, but it isn't infinite.
Right.
And in the public markets, it's 15 average for the S&P 500. These are the biggest companies. And they don't grow real fast.
Right.
So the average growth rate, including dividends, of those companies over the last 100 years has been about 7.5% per year.
Ooh.
And so if they're growing at 7.5% per year and they get a PE of 15, there's a neat little thing you can do right there. Is you can figure out what the PE ratio should be of any company that's public by doubling its growth rate.
Doubling its growth
long-term
rate.
Historical growth rate of its earnings.
That's what
Okay.
it should be, not what it is.
It's what it should be. And
Should
it'll
be.
vary depending on whether we're in a really robust, Mr. Market is manic and just
Right.
overly exuberant.
We're over
bull market,
exuberant right
or
now.
whether we're in Mr. Market is depressed and anxious and fearful, bear market. If it's typical, it'll be about 15 on the S&P 500, and in a bull market, double the earnings growth rate would be typical. In a bear market, it won't be that high.
Growth rate over
Right.
how long?
Long-term growth rate's like 10 years.
10 years.
Average growth rate, something like that.
We got to stay within that.
So the public markets
'Cause
tend to be
remember,
priced
even
quite
12,
rationally relative to
20 years, that's
liquidity
too
and
long.
and the information's out there about them. They're priced at about double what the same private company would go for. And the major point of this is that those prices are in a very defined range. They're not infinite.
Right.
So now we've kind of got an idea of how to figure out the value of that business, what people are willing to pay for it.
Right.
Because it's coming from how long is it going to take me to get my money back? What's the return on my money over a period of time? And that's
Right.
a relatively narrow range. So people are saying, yeah, I'll be willing to wait 8 or 10 years to get my money back if it's a good business. Or they're saying, yeah, I would be willing to get some rate of return on my money over time to take the risk. Now let's step into that little number real quick. 'Cause
Okay.
everybody uses a different number depending on what kind of businesses they're out to buy. We're looking at buying businesses that are really solid. We understand them. They have a great durable
Right.
competitive advantage, and we're putting a factor on discounting the value of all that cash flow in the future back to today as another way of looking at the value.
So you're
Okay.
moving from
Payback time.
the number we were just talking about, which is the payback time.
Right.
Right.
The number
To-
of years it's going to take to get your money back.
Right.
To a new number
Which is in business school called a discounted cash flow analysis.
where you're looking forward.
Right. Which we just say is a margin of safety price.
Margin
We're
of
looking
safety.
forward.
Looking
so what we
forward.
do with this, we can go into these numbers in the next time.
Yeah, this time let's do an overview.
Yeah.
And next time let's talk about where you actually find these numbers.
Okay. We'll
Yeah.
get to where you find them.
And what to do with
How do you
them.
know whether they're going to continue to be that number that you found historically, right?
Right.
Warren Buffett said if it's just a matter of looking out, at the history of a company, then all librarians would be rich. It's just like it's not just about.
I'm going to write down just so we know. Payback time. 8 years. At half price. PE. And then I'm going to write pay price divided by, what did he say? Earnings equals PE ratio. What it should cost. And then future earnings 10 year. And we'll talk more about this
Right,
clearly
and
next.
People are not very interested in investing. Most people, the numbers are the scariest part.
They're
Yeah.
killer, and they're very.
Even I'm still scared, honestly.
Intimidating.
I'm trying to
The good
understand
news
the
is
best I
there
can, though.
are 6 basic numbers we really pay a lot.
I think I'm getting there.
8 basic
Oh,
numbers.
stop it! Let's go back to 2.
There's only 9 basic. Okay,
10
there's a
basic.
handful
All right.
There's a
of
handful.
basic numbers, and we'll get into those. But there's really just 2 really good ways to look at the value of a business. The first way we talked about, which is sort of private equity, looking at buying a private business in a range of this 5 to 12 times earnings, depending on the growth and safety of it all. And then in a public business, looking at some PE multiple of the growth rate. PE multiple of the growth rate. So 2x the growth rate, effectively, gives you a way to figure out the value of the business. And then we're going to apply what's called a discounted cash flow
Can we back
analysis.
up?
Sorry, you're getting the weeds, aren't I?
Why did you go from PE number, which we discussed,
Yeah.
to 2x the growth rate? And we have not discussed how those things relate exactly.
Okay, I think we're going to have to
Okay,
pick
maybe
that
that
up
needs
next
to wait for our
time.
numbers.
We've got to pick that up next time.
I actually wrote that down underneath PE. I said 2 times the growth rate.
Because that's going to involve some heavy lifting
Okay.
to look at why growth rate gets you to the value of the business.
Okay.
Yeah.
So if we stipulate that somehow it does, and we'll believe you on that for the moment,
Okay.
but only for the moment, then let's move forward.
Okay.
So discounted cash flow was the other thing that you wanted to talk
Yeah.
about.
So essentially, that's the key thing. I think we actually ought to stop here because I think what we got to do is say, look, there's these 2 ways to value the business.
Cash
Looking at the
flow.
payback time is pretty straightforward from a private point of view. And how do we extrapolate that into the public markets? And then the second way is a discounted cash flow analysis that we call the margin of safety analysis. How do we come up with that
Slash
value that we get a
margin
margin
of
of safety
safety.
on? And we're going to talk about that next time.
Talk about those two
Those
in detail.
two in detail.
I think that sounds good because I'm already confused.
Okay, good. Confusion. We'll roll it right into the next one. And the next one's
And honestly, I've sped it up, so they're talking pretty fast. But we are going over this in the book as well, so don't forget to join us there on those episodes. And listening to this, like, I really thought by going off of the book that I was kind of like absorbing some of this, but re-listening to this, I'm like, maybe I haven't absorbed all the numbers and understanding of it as much as I can. So I definitely need to do some practice with them. I hope you guys do too. But until next time, guys, don't forget to like, share, subscribe, hit that bell icon down below so that way you know every time when I post. And I'll see you guys next week. Leave a comment down below. Do you guys understand this? Are you guys getting the math at all? Is there anything that you're confused about? Because trust me, I thought I was getting it, but now I'm like, maybe I don't. But yeah, until next time, guys. Till next week. Bye.